What is going on, traders? Welcome back to the Traveling Trader. Do you guys want to know where the term Santa rally came from? Well, obviously, it came from historical data showing that the stock market rallies during the same time in December. And you guys want to know when that time is, when we can expect a stock market rally? Well, I'm here to break it down for you, break it all down for you. Obviously, I'm not an oracle. However, we do have some extremely compelling data with an extremely high hit rate based on historical precedents and historical records. Just like we discussed with that September 17th date, saying that if you're in the short term, that is likely the day that you want to sell your stocks, because we do have historical data showing that that day is a record-breaking bad day in the stock market, right? And that you can pick your stocks back up in mid-October, because history shows that mid-October is when the stock market tends to pick back up. Well, we have very compelling data for December, so I'm here to break it down for you. So let's go over to our boy, none other than Mr. Larry Williams. Let's look at his YouTube channel. I didn't even know he had a YouTube channel, and I'm a huge fan of this guy. The data that we go over on this channel, a lot of the cyclical data is based on Larry Williams' research, and he is second to none. If you guys don't know who he is, look him up. So his I wouldn't even call it trading style, but his analysis is actually very basic. It's not like he uses some advanced algorithms. He just compiles data and mines it, right, historically, and showcases some pretty impressive things about historical best days and worst days in the market. And he does so across a lot of markets, not just the stock market, but crude oil, Bitcoin, etc. His data is second to none. So let's take a listen here and I'll react to it.
And here it is for December. If you are to buy on the fourth trading day, listen carefully now, guys, left in the month. So that's right at the end of the month. In the last 23 years, that trade has been successful 22 times, 95% accuracy. In fact, starting with 4, 5, 6, 7 trading days left in December, look at that, 95% accuracy. Now, all we're doing is buying on the opening of, say, the fourth trading day left of December.
So he's actually, what he's buying or what he's showcasing here is he trades the S&P E-mini futures, but you certainly don't have to use S&P futures. You can use like SPY options or just the SPY ETF itself. However, I'm going to talk about trades after this video. Let's just continue with this video. And then I also want to talk about why this last trading day left in December, why we see this big red mark, why it's traditionally a down day, and how we could potentially play this too. We'll talk about that in a second. So let me hear some more of what Mr. Larry Williams has to say.
We're going to use a $2,500 stop loss, and we're going to get out of that trade after being in the trade for at least one day.
So this right here, he's referring to the stop loss. So he uses a minus 2,500 stop loss, meaning that if he's down $2,500 in the trade, that he gets out, right? So his mode of operating with regards to trades, or at least these examples are based on a trading situation in which you open up the trade in the morning and close it out either by the end of the day or the next day. Now, he does advocate, and I certainly advocate, that you don't follow this to the T, meaning don't wake up on, with the fourth trading day left in December, open up a position regardless of what you see on the chart. Again, I will go over the trade section of this in the second part of the video. So let's continue here.
Look we can get from the market is looking at the advanced decline line that's shown in black here. The advanced decline line is really important. It's the number of net stocks advancing or declining each day. You want to take out preferred stocks and convertibles and stuff, and then you get the real sense of the internal strength of the market. And I can run cycles on that, which is really fascinating. This is not price. These are cycles in the advanced decline line, the internal X-ray, if you will, of the marketplace itself. And you can see when we've had cyclical lows, we've rallied in this market. Recently, a cyclical high. It's also saying around the 10th, 11th, somewhere in this general time frame, we should see a rally in the marketplace.
So based on his cyclical data, he's saying that we should see a rally in the marketplace basically next week from the time of this recording. So the second full week of December, I think it is, the first trading day will be December 13th. So he's saying that during this week, we should see the week of December 13th is when we should start to see that December rally. Now, if you looked at my last video, I would argue that we already started the December rally. What I was saying in my last video and also on Twitter was, and also on the live stream, was that I think that the market already is priced in all the inflation data. So I don't see the inflation data causing a rift in the market. That is why we saw the stock market rally, even though the inflation data came out and it was obviously high, but the market had already expected that. So I think that inflation data was the catalyst to spark the December rally. One wrench that could be thrown here is what the Fed does on December 15th. So keep your eyes and ears open for December 15th, because if the Fed introduces more aggressive policy than expected, then we could see a downturn in the market. If the Fed does what we expect them to do, which is announce a faster taper, and that's it, then the rally will continue, in my view, because there is simply nowhere else to put your money. And the SPY will be making all-time highs in the event of a new rally. We almost hit a new high on Friday, closed at 470.74 on the SPY, which actually might be an all-time high close. Yes, I take that back. It wasn't an all-time high price point, but it was an all-time high close. So based on the cyclical forecast of the advanced decline line by Larry Williams, he's thinking around December 13th as the start of the rally. And then looking at the best trading day of the month, it looks like 4 trading days left in December. So that would put us at the 28th of December this year. That's when there will be 4 trading days left in December. That has historically been the best trading day of December. This is going back over 23 years. 22 of the 23 years, there was a winning trade to be had in the SP 500 with 4 days out. Now, the same hit rate is also projected on the 7th day of the 7th trading day left in December. So that would put us at, let's see, market is closed on Friday because of Christmas. So 7 days, 1, 2, 3, 4, 5, 6, 7. So that would put us on the 22nd of December. Now, that really, so if Larry Williams' data is showing that the rally based on cyclical forecasts is going to start somewhere around Monday or Tuesday, and that the 22nd of December and the 28th of December are the 2 best trading days of the month. So really, if you compact all of that together, it shows that they're based on historical data. There is reason to believe that we will see a Christmas rally starting sometime next week. And again, in my view, we already started the Christmas rally, and we might see some shakiness, right, leading up to the 15th Fed meeting date, just because we don't know what Jay Powell's going to say. And even worse, if Jay Powell says something unexpected, then we could this whole thing, like what I'm showing you right now, this whole thing could be basically irrelevant. So take it with a grain of salt. I will be sending out all of my trades in the trade alerts, by the way. So sign up below if you want access to that. Also, if you aren't part of the trade alerts and you want access to a free stock watch list where I will send it to you every single week on Sunday, put your email address in the description below. You will see an email sign up form. So just put it there and I will send you my watch list for free. If you're already part of the trading group, you don't need this, as you get my watch list anyway. All right. So here are some trade ideas of how you would trade this. Now, nothing is a substitution for building a quality long-term portfolio. So please, you don't get this misconstrued and think that this is an all-in trade, right? One, this is really just for educational purposes, so you know historically how the market reacts. But two, if you did want to trade it, the way that I would trade it is this. I would potentially wait for, if I want to trade specifically this trend, because I'm already overloaded on the S&P 500 itself through the SPY ETF. But if I wanted to trade this specific trade, then I would actually wait to see any weakness leading into the December 15th Fed date, right? So either Monday, Tuesday, or Wednesday, we get some weakness. This potentially can turn into a double top, not a full double top, but maybe decline to the 21 EMA, maybe even the 50 MA if this thing gets really violent, although I don't really foresee that. And if what Jerome Powell says is expected, then I would likely open up a vertical called debit spread on the SPY, or I'll monitor the charts intraday, draw my support and resistance. I did a whole video on how to trade day trade S&P 500 options, basically SPY options, finding support and resistance from previous days. So I would find support and resistance and actually enter naked call options, basically buying call options on the days that I just specified from the last segment, talking about the best trading days in December. And I would likely get out of those call options same day, or maybe hold them overnight. Those are the two ways that I would play this data here, this really informative and valuable data that Larry Williams has compiled and data mined for us. Now, you see, with one trading day left, I said I was going to talk about this. The reason that this is always red, or mostly red, is because this is the date that most people sell stocks due to what they call tax loss harvesting. This is basically reducing your exposure on your gains by locking in losses on stocks that you don't want to hold anymore. So let's just say that you hold a bunch of Workhorse or Hyliion or whatever, stocks that you know will never see their prices that you likely bought them at, or some of you bought them at. Then in order to offset some of the gains that you made on your Tesla and your Apple and your Microsoft, etc., you would sell those stocks and not bag hold them. That's why diamond handing is really such a childish concept in my view, because it really lacks context and nuance. But there are times when offloading your bags for a loss is actually advantageous, or else that money is just going to go straight to the government, right? If you don't take these losses against your gains, and you're just holding on to these stocks well into next year, past that December 31st date, then you are basically going to be paying more in tax than you need to, as opposed to actually taking some of those losses and offsetting your gains. But that does not surprise me. That is why you see that the wins start to decline towards the end of the month, and then the last day of the month, you see mostly a loss because of that tax loss harvesting. So keep in mind that really, if you're looking on when to sell in your short term, really the power hour of when to sell is after 4 trading days left in the month. So if you executed a trade on the 28th of this year, which is 4 trading days left in the month, and you're up in profits, please take profits. Obviously, if it's a short-term trade, again, I'm not talking about long-term investing here. And just know that the last 3 trading days of the month are not only brutal because most people are selling stocks for tax loss harvesting, but also because they are low volume, since it's leading up to New Year's and nobody really wants to trade. Anyway, guys, there you have it. Hopefully you learned something in terms of historical data and why Santa rallies exist, why that concept exists. Again, this is for educational purposes. It doesn't mean you should go all in on the 22nd or the 28th of December. It doesn't mean that you should sell your stocks if you have a long-term high conviction portfolio. Do what is good for you. Do what is good according to your risk tolerance. This is just talking about a short-term trend. And if you are a short-term trader, you might want to play a short-term trend. If you aren't, this just might be good information for you to monitor and maybe learn from for the future. If you got anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know whether you're going to be taking this trade, whether you're short-term, long-term, what you think of the Santa rally. Do you disagree or agree with this information? Do you find it informative? I love hearing from you guys. Leave it in the comment section below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.